Good day, everyone. Our topic for today is all about the controversies and opportunities of foreign finance, investment, aid, and conflict. And there are five following subtopics. These are number one, the international flow of financial resources. Second is the private foreign direct investment and the multinational corporation. Next is the role and growth of remittances. Fourth is about the foreign aid, the development assistance debate, and the last one is about its conflict and development. And after this chapter, we should be able to examine the international flow of financial situation, discuss the nature, significance, and controversy regarding private direct portfolio investment and foreign aid and the context of the changing world economy, elaborate the consequences and causes of violent conflict and developing nations and its strategies for its prevention, distinguish the critical role of private foreign direct investment and the multinational corporation few developments, and describe the roles and growth of remittances. Also examine the foreign aid, the development assistance debate, examine the conflict and development, its scope of violent conflict and conflict risk, also the consequences of armed conflict. Moreover, the causes of armed conflict and risk factors for conflict and the resolution and preventions of armed conflict. In Chapter 13, we explain that a country's international financial situation, as reflected in its balance of payments and its level of monetary reserves, depends not only its current account balance or its commodity trade, but also on its capital account balance or its net inflow or outflow of private and public financial resources. It is because a majority of non-oil exporting developing nations have historically incurred deficits on their current account balance. A continuous net inflow or foreign financial resources represents an important ingredient in their long-run development strategies. These recurrent requirements are amplified by the need for targeted resources for investment in the key sectors and for carrying out poverty reduction strategies. So in this chapter, we examine the international flow of financial resources, which takes in three main forms. We all know that a majority of developing nations have historically incurred deficits on current account balance. So inflow of foreign financial resources plays an important role in long-run development strategies. Resources needed for investment in key sectors and for carrying out poverty reduction strategies. The three main forms, these are the three sources. First is the private foreign direct and portfolio investment, consisting of foreign direct investment by large multinational or transnational corporations, usually with headquarters in the developed nations, and foreign portfolio investment, such as stocks, bonds, and notes, in developing countries' credit and equity markets by private institutions, such as banks, mutual funds, and corporations, and also individuals. Second is remittances of earnings by international migrants. And third is the public and private development assistance, such as foreign aid, and it's from individual national governments and multinational donor agencies, and increasingly, private non-governmental organizations or NGOs, and most working directly with developing nations at the local level. And also, we examine the nature, significance, and controversy regarding private direct and portfolio investment and foreign aid in the context of the changing world economy. As in earlier chapters, our focus will be on ways in which private investment and foreign aid can contribute to the development and on ways in which they may be harmful. We we then ask how foreign investment and aid might be best serve development aspirations. And for the second subtopic, which is the private foreign direct investment and the multinational corporation tree developments, in which it played a critical role in the extraordinary growth of international trade and capital flows during the past few decades as the rise of the multinational corporation or MNC. An MNC is most simply defined as a corporation or enterprise that conducts and controls productive activities in more than one country. These huge firms are mostly based in North America, Europe, and Japan, but a growing number are based in newly high-income economies such as South Korea and Taiwan. In recent years, a much smaller but growing number of MNCs have emerged from upper middle income countries such as Brazil and even some fast growing lower middle income countries, most notable China. MNCs and the resources they bring present a unique opportunity, but may pose serious problems for the many developing countries in which they operate. The growth of private foreign direct investment or FDI in the developing world has been extremely rapid though volatile in recent decades. A key part of globalization, FDI growth has come in waves, with each crest higher than the one before it, as seen in Figure 14.1. It rose from an annual rate of $2.4 billion in 1962 to $35 billion in 1990 before surging to $565 billion in 2007 when total world FDI hit its record of just over $2 trillion. In the aftermath of global crisis, FDI fell considerably, and in 2012, the total was some $1.35 trillion, barely two-thirds of its level 5 years earlier, with only a gradual global increase anticipated. Yet, despite this overall global trend, FDI continues to play an extremely important and indeed growing role in the developing world in 2012. Inflows to developing countries were about $700 billion, an extraordinary flow of resources. And indeed, 2012 represented a new milestone. For the first time in history, developing countries received more than half of all global FDI flows. On the other hand, a significant part of this changing share over the past few years has been due to a sharp fall into investment developed countries, reflecting the aftermath of the crisis and in particular the continued recession conditions in much of Europe. As you can see here, it is remarkably by 2012, developing countries were also the source of nearly one-third of global FDI outflows. Although these represent a continuation of general trends that began from the mid of 1980s, they are now reaching high shares far more rapidly than anything expected by the analysis of the turn of the century. Also, this is occurring while outflows from developed countries fell sharply in 2009 in the wake of the financial crisis, rebounded by a couple of years, but by 2012 to 2013 had fallen back close to the 2009 too. At the same time, these funds are originating from a small number of relatively successful middle-income developing countries. To some extent, this is also reflects that development gaps among developing countries have become greater than ever. And according to United Nations Conference on Trade and Development or UNCTAD, estimates that in 2012, a little over two-thirds of the profits from FDI in developing countries were repatriated back into investor countries. On the other hand, the remainder was retained, much of the reinvested. The instability of growth in FDI flows over time into both developed and developing countries can be seen in Figure 14.2. Interestingly, at least since the late 1990s, The volatility of investments going into developed countries has actually been greater than those going into developing countries. The volatility of flows to various regions is even greater than total flows. And in most years, a majority of FDI goes from one developed country to another, and flows to developing countries are heavily concentrated in just a few destinations. For example, in 2009, 31% of all inflows to developing countries went to China, including Hong Kong and Macau. Africa has usually received only a small fraction of inflows. In 2009, FDI in Africa totaled $59 billion, but the share of global FDI going to Africa as a whole was just 5.3% or 3.6% excluding North Africa. But as you can see, even this was higher than recent years, largely driven by commodities investments. Most of the 34 least developed countries in Africa received very little foreign investment. This is not surprising given the fact that private capital gravitates toward countries and regions with the highest financial returns and the greatest perceived safety. Where debt problems are severe, governments are unstable, and economic reforms remain incomplete, the risk of capital loss can be high. We must recognize that multinational corporations are not in the development business. Their objective is to maximize the return on capital, and MNCs seek out the best profit opportunities and are largely unconcerned with issues such as poverty, inequality, employment conditions, and environmental problems. FDI flows need to be understood in context. Despite the extraordinary growth, FDI inflows to developing countries have remained a small fraction of these countries. Total investment, most of which is accounted for by domestic sources. Note that, however, foreign investment may be qualitatively different from domestic investment and may have beneficial interaction effects, and in some cases, which in turn may depend on policy, as discussed later. Nevertheless, in recent years, FDI has become the largest source of foreign funds flowing to developing countries, as Figure 14.3 shows. Globally, MNCs employ about 80 million workers in countries outside their home base. Nonetheless, in most developing countries, MNCs employ a relatively small fraction of the workforce, but the jobs tend to be concentrated in the modern urban sector. Moreover, foreign direct investment also involves much more than the simple transfer of capital or the establishment of a local factory in a developing nation. Multinationals carry with them technologies of the production, taste, and styles of living, managerial philosophies, and diverse business practices. But before analyzing some of the arguments concerning incentives for or restrictions against private foreign investment in general and multinational corporations in particular, let us examine the character of these enterprises. And there are two central characteristics of multinational corporations are their large size and the fact that their worldwide operations and activities tend to be private foreign investment. The pros and cons, traditional arguments in support of the private investment. The four main arguments are filling savings, foreign exchange, revenue, and the management gaps. The first one is the contribution to national development in terms of promoting economic growth via filling the resource gap between targeted invested and locally mobilized savings. The second one is the contribution to filling the gap between targeted foreign exchange requirements and those derived from net export earnings plus net public foreign aid. And the third one is contribution to tax revenues on top of local taxes. Taxing MNCs profits helps developing countries better able to mobilize public financial resources for development projects. And the last one is the contribution to management experience, entrepreneurial abilities, and technological skills that can be transferred to local counterparts by means of training and the process of learning by doing. Additional arguments against private foreign investment. There are two main arguments, the economic and ideological. In economic, FI may lower domestic savings and investment by substituting for foreign savings, discouraging competition through exclusive production agreements with host governments, failing to reinvest much of their profits, generating domestic incomes for groups with lower savings propensities, and inhibiting the expansion of indigenous firms that might supply them with intermediate products by instead of importing these goods from overseas affiliates. MNCs also raise a large fraction of their capital locally in the developing country itself, and this may lead to some crowding out of investment of local firms. Ideological arguments refer to policy thought some of above concerns. MNCs may reinforce dualistic economic structures and exacerbate income inequalities. It also worsen the imbalance between rural and urban economic opportunities. MNCs may produce inappropriate products or demanded by a small or rich minority that stimulate wrong consumption patterns through advertising and market power and with capital intensive technologies. They create relatively little employment. MNCs may cause socially undesirable allocation of domestic resources. MNCs may have adverse impact on government policies in terms of concession, tax holiday, and cheap factory sites. MNCs may suppress domestic entrepreneurship, and it may gain control over local assets and jobs and then exert considerable influence on political decisions at all levels. Reconciling pros and cons, accept foreign investment with the responsible policy, the maximal benefit from MNCs. What is portfolio investment? Basically, portfolio investment refers to foreign purchases of stocks or equity, bonds, certificates of deposit, and other commercial papers in a home country. Private portfolio investment, benefits and risks. Its benefit is to raise capital for domestic firms to diversify their assets, and its risk is portfolio funds can flow out back unexpectedly, causing instability for both financial market and the overall economy. Emerging also country stock markets.